Using moving averages by themselves as an area of value, yes, it can help you create a profitable trading strategy, but the more confluence you add to moving averages, the better off you're going to be, the more accurate those trades are going to become. And so what I'm going to do now is show you some of my favorite ways to add confluence to moving averages in order to create some of the most profitable trading opportunities possible and some of the most accurate trading opportunities that you could possibly get using. Let's dive into the charts and talk about it. This is how I like to add confluence with moving averages, and quite frankly, one of my favorite ways to trade using moving averages is to do this. I wait for the market to touch the moving average. At the time we are looking at the chart right now, this is the 200 period moving average. Once I touch the 200 period moving average, and I'm going to show you a live trade of me actually doing this today. I had 3 trades doing this, 1 loss and 2 wins. I'll show you in just a second. But once we touch that moving average, I'm going to put a horizontal line there. And actually, I'm going to make this a zone because support and resistance are not zones, right? But if I look left from this zone that I have, what do you see? This is not only the market hitting an area of value because of the fact that we are at the 200 period moving average. We also have that lining up with previous major structure resistance and support. So one of my favorite ways to add confluence to moving averages is to say, I will not trade the 200 period moving average unless when the market hits the 200 period moving average, it also lines up with structure looking left. And then I'm going to start talking a little bit about the strategy now. I'll go into full detail after I let you take a look at those live trades. But let's talk about the strategy a little bit right now. We know we're in an area of value because of the 200 moving average. We know we're in an area of value because of this confluence with our previous level of resistance that was support in the past as well. Now, what I would be waiting on in this specific case is a candlestick pattern or some type of selling pressure like we just saw right there in order to enter the market. So what do I mean by selling pressure? Well, if you do not see the selling pressure here, then you got to go get yourself some glasses. This is a long and large wick that came out of our area, sucked all the way back down. That to me is showing selling pressure. That would be an entry candle. And when I say selling pressure, again, I'm going to talk a little bit more about a rules-based strategy after I show you the live trades from today. But you could set yourself up something like this with a 1.4 to 1 reward to risk on that with our stop loss above that wick. And you can see what happens. I say 1.4, obviously pick and choose your targets the way you would like to. For me, 1.4 is my first target. And then I manage the position on the way down. And that is how I like to use confluence with moving averages and structure levels in order to point out some of the most powerful trading opportunities that exist. And with that being said, what I'm going to do now is let you take a look at a couple of live trades I had, day trades earlier today using this exact type of strategy, and then we're going to dive deep into an actual rules-based strategy. You can come away from this video with a way of trading that is rules-based, objective, and that if done correctly can help you to gain an edge over the market. So with that said, take a look at these live trades. I will be right back. So as we were just talking about, another way I like to use this type of confluence is with chart patterns. So if you look on the screen, you can see that we have a double bottom, but what's different about this double bottom? Well, this double bottom is happening at the 50 period moving average. So when you have an area of value you can combine this price pattern with, it can really increase the odds of this being a winning trade. So with that being the case, this is a trade we're also going to go ahead and take today. Chances are I'll probably end up losing one of these, but I did want to give you guys examples of both of these in live trades. So let's go ahead and risk, I might use 0.5 on this one just because of the margin level that it allows. It only allows for a 25 to 1 on the Canada Swiss for Oanda. So I'm going to use 0.5 so that I'm not super leveraged here, and I'm ready to go. So we are involved in this trade, and now what I want to do is show you guys another trade that's actually on my radar right now using the same exact strategy. So let's take a look at that live trade as well. Here we have another example of using a price pattern at an area of value, that area of value being the moving average. So as we discussed, our rules for this type of price pattern, this is an example going short. And for this example, we're looking at a double top. So we have our first top, and the rule would be on that second test of that resistance level, you would want to see that second test at least touch the 50-period moving average, and you don't want to see candles with space above it. This is just how you would make a rules-based system around this. What I mean by space above it is you say you get a green candle that looks like this. If there's nothing touching the 50 moving average, not even a wick, then you don't want to take that as a double top trade and expect the market to head lower, because that's telling you that we've made it above our area of value. But if candles are clustered around on that second top, or if a candle just touches with the wick like we have here, then that's a pretty good indication that we could see a fall out of this market. And with that being the case, let's see if I can get an entry here on this trade as well. And let's go with our stop loss, which is going to be about 4 pips above. Get our stop above this level over here, because we do have a pretty nice distance down to our level of support if this market continues in this downtrend. So we're going to look for a 1.4 on initial targets. And there we go. We are entered into this trade. I'll keep you guys updated as it plays out. I am going to go ahead and close out our euro yen position here. We are at a nice level of support that I was looking at for targets, and we are going to exit this position for around a 2-to-1 reward to risk ratio. Nice trade. Hey guys, I'm going to go ahead and jump out of this Canada Swiss position. It's 458 right now, and the spread's starting to go up. Just a little hint, if you are going to day trade, make sure if you're on a 5-minute chart that you're not trading on a pair that has a large spread at 5 o'clock p.m. You will be stopped out by nothing more than the spread alone. So with that being the case, I'm going to go ahead and close this position for a profit of $110. So in order to turn a moving average into a reliable rules-based strategy, I use a process and a phrase I call CEST. This stands for conditions, entries, stops, and targets. If you have all of these as rules in a trading plan, then you will have a rules-based trading plan that will be easy to follow. So for conditions, all this means is that these are the things we look for before we look for an entry. So in the case of the strategy you're learning right now, what are the conditions for this strategy? Simply put, we are trading price action patterns like double bottoms and double tops that form at a moving average. So with that being the case, the first thing we're going to look for in our CEST is the conditions, which are going to be, we want to see the market above the 50 moving average. This is for a buy trade, okay? Everything would be backwards for a sell trade. Before a buy trade, we want to see the market above the 50. The second condition we want to see is a double bottom. Now, the third condition is that that double bottom at least touches the 50-period moving average with one of the bottoms. Whether that be the first bottom or the second bottom is irrelevant, but we want the double bottom to at least touch the 50-period moving average. Once all of those conditions are met, we are ready to work on the entry. So those are all the conditions for our strategy. That's what we need to see before we can try to enter the market, before we can look for an actual entry reason. And for me, using price action patterns like double bottoms, what I like to use for an entry is just a confirmation candle. In the case of a double bottom, that would be a green candle. So I'd be looking for a green candle, and also I want that candle to close above the 50-period moving average. So just a quick overview. We're looking for the market to be over the 50-period moving average. And the entry, how easy does that make trading? No more confusion whenever you look at a chart and you're thinking to yourself, man, should I actually trade this or not? We're at support. I want to click the buy button. Should I do it? No. At this point, you wait for every condition to be met. You ask yourself, is the market above the 50-period moving average? The answer is yes. Awesome. You ask yourself, did we just create a average? If the answer is yes, you continue the process looking for entries. If you find the entry, which is a green candle, you ask yourself, did this green candle close above the 50-period moving average? If the answer to all of your questions is yes, you are now ready to enter the market on a rules-based system. No more confusion at all. This is something that's so powerful, and literally the reason, and this is what took me from being an inconsistent losing trader to someone who is consistently profitable, is using this CEST. Now, you're ready to get in the market after all your conditions and entry is met, as long as you know the next two, which is stops and targets. Now for stops and targets, because I'm not going to have a lot of time to dive deep into them in this video, what I'm going to do is just do a very simple stop of 1 ATR below the swing low, and our target is going to be a 1.4 to 1 reward to risk profile based on that stop loss. ATR, for any of you that do not know, is the average true range. What it does is measures the volatility of the market based on the last 14 candles. I will put a video I did on the ATR that explains it in full to the top right side of your screen. But now that you know the conditions, entry reasons, stops, and targets we are using with today's strategy, let's take a look at this Canada Swiss trade we had earlier. Let's ask ourselves the questions that are necessary first. Is price above the 50-period moving average? Yes, it is. First condition met. Do we have a double bottom? Well, not yet. Here's the rules for my double bottoms. All I do, very, very simply, is I place a box on the lowest body of the first bottom and on the lowest wick of the first bottom. This box is considered my termination point. What I want to see is a candle at least touch this box with a wick. The body of the candle can close in this box. The wick of a candle can go below this box. What I do not want to see is a candle that closes below this box. At that point, it's signaling trend continuation to the downside, and I do not want to buy when I'm thinking trend continuation to the downside. So let's take a look at how this played out. As we push down, do we have a double bottom now? Yes, we do. We have the touch of our box. That classifies as a double bottom for me. What are we looking for now? We have all of our conditions met, right? We're above the 50. We have a double bottom. The double bottom is touching the 50-period moving average. Next is our entry. What is our entry? A green candle that closes above the 50-period moving average. So let's see if that's something we get during this trading opportunity. And guess what? If it's not, we don't place the trade. That's how easy this is. If we get what we're looking for in terms of the green candle that closes above the 50 moving average with all of our other conditions met, then we place the trade. And if we don't, then we do not place the trade. Super, super easy. Is that a green candle? Pretty easy to recognize, right? Yes, that is a green candle. So at this point, I would be entering the trade on the close of that candle or the open of the next one. They're normally the same thing in the Forex market, but at that point, what is our stops? 1 ATR below the swing low of the double bottom, right? Here's the swing low of the double bottom. ATR at this candle is 3 pips. So 3 plus 4 is a 7 pip stop loss. What is our target? 1.4 to 1 reward to risk, and our trade is set up. Now, I want you to think again about how easy this is. Once all your rules are met, you just enter the trade, and how much easier trading is going to be without just guessing every time you place a trade. Right? How much easier is it going to be to have rules like this? Conditions, entries, stops, and targets every single time you place a trade. Let's see how this specific trade played out. Played around a bit near the entry and eventually pushed up, hitting targets. Again, if this trade looks familiar, it's because this is the trade we had earlier, and I ended up exiting the trade because it was 5 p.m. for like $110 or so. Now, this is all well and good, but one of the most important parts of having these rules, beyond it helping you stay consistent to your plan, is you using these rules to take them in historic data and test them and practice the strategy. This is a process called backtesting. The rules you just got, the CEST we just discussed, can easily be written down on a piece of paper. You can put that piece of paper beside it. Go through a specific the last 100 times that they have in the future. There is no guarantees in Forex, but it's likely to. And if it did not, then that means it's likely not. The reasons we have all of these rules in place, the conditions, the entries, the stops, and targets, is not just so we can stay consistent to the strategy because it's based around a set of rules, but it's also so we can take those rules and test them to make sure that the strategy we're trading does produce a profit over a long period of time. So now that I've talked about that and went on my little rant, let's dive back into the charts and take a look at a bearish version of the same exact strategy. All right, so for a bearish version, what are we gonna be looking for? The opposite of what we were just looking at, right? We wanna see that price is below the 50 moving average. We wanna see a double top this time instead of a double bottom. We wanna see that one of these tops touches the 50 moving average. As long as one of the tops touch the 50 moving average, our third condition is met, and then we start looking for entries. On a double top, it's going to be a red candle, and that red candle needs to close below the 50 moving average. So let's see how that plays out on our screen. Right now, do we have our first condition met? Is the market below the 50 moving average? Yes, of course it is. Very easy to tell that because we're below the blue line. Next, let's see if we get a double top. There we have it, a double top. Does that meet all of our rules so far? It does, because this double top, similar to how the double bottom was, the box just goes from the top of the bodies of the first top to the top of the wick, and this is the same termination point. We don't want to see a candle that closes above this termination point, but we can have a wick above it, and we can have a body that closes inside of it. So with that being the case, let's push the market forward because we only have two conditions met. We have a double top that's below the 50 moving average, but our third condition is that the second top must touch the 50 moving average, which has not happened yet. So let's continue. And there we have it. Is this still following my rules for a double top? We don't have a close above this line, so yes, it is. Is this touching the 50 moving average? Yes, it is. So right now, we have all three of our conditions met, and we're looking for that entry, which is a red candle that closes below the 50 moving average. Move forward. My, oh my, would you look at that? With that being the case, do we have a moment where we can enter the market based on this rules-based plan, this objective plan that we've created so far in this video? Yes, we do. We enter the market. We have a 3-pip stop loss here as well, and above our swing high, which is 1. I'm going to do 4, so that's going to be about 5 pips. Actually, 4 pips is fine, and a 1.4 to 1 reward to risk ratio. Right there we have it. Now let's see how this specific trade plays out. Boom, immediately pushing down. And of course, all trades will not immediately go to profit. All trades won't even win. This is just a way of combining technical factors, getting your confluence, and then turning that confluence into a rules-based trading plan. That's what I wanted to teach you here at the end of this video, is how to turn any technical confluence like moving averages combined with price action patterns into a rules-based trading strategy you can actually implement. You can go back test, you can see if it'll work in your trading plan, and then decide whether or not you would like to. And if this trade looks familiar, it is also because it's the Euro-Yen trade we had where we took profits right down here just because it was such a beautiful trade. Let's go ahead and let the market run. There we go. We had our targets at about I think I ended up getting almost a 3 to 1. I think I said 2 to 1 earlier in the video, but I got almost a 3 to 1 on this one. And with that being the case, what I ended up having was these were all about a $500 risk. So I had 500 times 3-ish. So 1,500 on this trade. I had a negative 500 on the Aussie Canada trade, bring me to 1,000. Plus I had the $110 win because of the 5 p.m. candle on the CAD Swiss, bringing my grand total using this to $1,110. Now, that is not, again, any guarantee. I just wanted to add it up on the screen to show you the power of just winning 2 trades out of 3 and having a decent reward to risk ratio. Lastly, we are going to take a look at the losing trade. Okay, another bearish trade.